Now that we have covered all the basic knowledge about options, are we ready to give it a go? Actually, we still need to familiarize ourselves with how to actually trade options. Next up, we will use the Tiger Trade app to demonstrate the key steps as well as the do's and don'ts of actual trading. As with buying stocks, first you must choose an option. After entering the option chain, select a contract to see the details. At this time, you can see that there are 3 trading options: buy, sell, and close. When you don't have any contracts in your account, you can only buy or sell. Both directions are called opening. After you've opened a position, you can choose to close it. Closing is the opposite of your original position. If you hold a long position, closing is selling. If you hold a short position, closing is buying. Generally speaking, after opening a position and buying an option, there are 3 key trading strategies. The first way to execute an open position is to sell and close the position before the expiration date. Assuming that Tesla's share price stands at $1,000 on October 1st, Tim is very optimistic about the future and buys a Tesla call with expiration date on December 31st and a strike price at $1,100. The total cost is $1,000. Tesla's share price subsequently rises, as does the call price. Assuming that Tesla's share price rises only 6% and stands at $1,060 on December 1st, Tim finds that the call is now worth $2,000, a rise of 100% over the purchase price. With 30 days to go before the expiration date, Tim decides to cash in. He clicks on Close the Position to sell the call and, excluding commission, realizes a yield of 100%. Of course, this is assuming a favorable movement. If Tesla's share price barely rises by December 1st, Tim could suffer a loss of $500 as the time value is declining. He may then choose to close the position in order to stop the loss. The second way to execute an open position is to hold the option until the expiration date. Let's use the same example as above. Suppose that by December 31st, Tesla's share price rises to $1,200. Tim chooses to exercise and buy one lot of Tesla, 100 shares, at $1,100, which means that he needs to deposit at least $110,000 to maintain account margin. Net income equals $1,200 minus $1,100 times 100 minus 1,000 USD, the option principal, which equals $9,000. And the yield is as high as 900%, excluding commission. What if Tim doesn't have enough margin? Brokerages will check client accounts a few hours before the closing of the exercise day. If they find that the margin is insufficient to exercise, they will directly close the positions at the market price. As the market price may not be the optimal price, if the margin is insufficient, we suggest that you take the initiative to close your positions at a satisfactory price. There is another possibility. After the brokerage firm helps you exercise the option, it forcibly closes some stock positions on the second trading day. Why? Because options of U.S. stocks feature physical delivery. As mentioned earlier, in addition to stock options, there are also index options, which can be delivered in cash. For example, if Tim instead trades S&P 500 index options and earns $9,000, according to the calculation just mentioned, $9,000 in cash will be directly deposited into his account. There is no need to really buy the index or for the account to have a corresponding margin. How do you calculate the funds required for exercising an open position? You can refer to the margin requirement ratio of the corresponding shares. If the margin requirement of the underlying shares is 30%, you will need to have the current price times 30% times the exercise quantity in your account. Of course, these are all for options which expire in the money. Generally speaking, there is only one result for out-of-the-money options after expiration: complete loss. On December 31st, if Tesla's share price does not rise to $1,100, the buyer will certainly not choose to exercise, and the call of $1,000 will disappear from the account the next day. Some of you might wonder, is it possible for out-of-the-money options to be exercised? It is actually possible. If the buyer originally wanted to buy a large number of underlying assets and the current liquidity is average, buying more directly may push up the price and raise the purchase cost. Therefore, if the options in hand are slightly out of the money, exercising the options may reduce the total cost. The above is about buying options and opening positions. We told you from the first session that you should also learn the risks and benefits of option selling, as in many cases, the odds are in the seller's favor. Next, we will use the TigerTrade app to demonstrate option selling operations. On October 1st, Tim sells a call with expiration date on December 31st and strike price of $1,100. He receives $1,000 as a premium. This means that he is not taking a very aggressive calculation. Before the expiration date, Tesla's share price falls, and the premium of $1,000 is his highest profit. By November 1st, assuming Tesla's share price falls to $900, the call sold by Tim may decrease in value from $1,000 to $200. Although it is still 1 month away from the expiration date, Tim has realized 80% of the income of $1,000 US. How to calculate this? $1,000 minus $200 divided by $1,000 equals 80%. Tim thinks along the following line. The call expires in another month. Even if the call sold by him becomes completely worthless, he can only earn another $200 at most. He also faces the risk of a sudden sharp rise in Tesla's share price. It's probably better to close his position and cash in. What if Tim chooses to hold the option until expiration? Obviously, if the call sold by Tim becomes in the money upon expiration, Tim must fulfill his obligation to sell 100 Tesla shares at $1,100. If a put is sold instead of a call, he must buy the shares at the strike price. Of course, ideally the option sold remains out of the money and hence will not be exercised. Tim pockets the premium and his obligations expire. As an option seller, if the option does not become worthless on the expiration date, what is the delivery method? If Tim sells a call and he does not own the shares being exercised, the margin in his account will be used to short the corresponding shares at the strike price and the shares delivered to the call buyer. Here you will ask, what if he has no money in his account? The real situation is that when Tim wants to sell a call, the system calculates the margin he needs for this transaction. If the margin is insufficient, the order will fail on the spot. In the case of a rising share price, if the system finds the margin in his account is no longer sufficient, it will ask for additional margin. If Tim fails to deposit additional funds, he may be forced by the brokerage to close the position. If Tim sells a put, the margin in his account will be used to buy the corresponding shares. There is no upper limit on the loss of selling a call. But what about selling a put? The worst case is that the price of the purchased stock falls to zero. So the upper limit of the loss is the strike price multiplied by the number of shares corresponding to the option position. Now to summarize. 1. You can open a position by either buying or selling an option. 2. The option buyer can choose to close the position in advance or exercise the option upon expiration. The exercise of stock options requires sufficient margin. Out-of-the-money options are generally worthless upon expiration. 3. Selling a call requires a higher margin, and there is no upper limit on the loss. The loss of selling a put is the strike price minus the current price minus the premium and then multiplied by the corresponding number of shares. If the current price is zero, in extreme cases, the biggest loss is the strike price multiplied by the number of corresponding shares and minus the earned premium. What are common options trading strategies and which are most suitable for you? We'll talk about this in the next session.